Welcome back to Lamb's Cryptoverse. Today was a very big day because the Fed raised rates 75 basis points, and it looks like they ain't stopping soon. So I'm going to think that we're going to have at least a 50 basis point rate hike in December and then another 25 points thereafter. Now, why did the market go down? Everyone knows this, or most of this, unless you're living underneath a rock. Why would the market, especially in NASDAQ, go down over 3%? This is because the Fed, which seemed dovish to me, because they said they're going to be looking at lagged, and they're going to acknowledge that economic data and the PCE, the inflation data, is lagged. So they're going to be looking at cumulative data coming in. They're acknowledging that there's a lag when they raise rates on the cumulative basis. There's a lag to when the economy's inflation slows down. So why did the market and investors get scared and sell equities and even treasuries? So treasury rates went up today. Why in the heck would that happen? Because I hate to say it, it's hard to believe, but investors were looking for the word pivot. Instead, Jerome Powell said he's going to raise rates and then hold them. Raise and hold. And you know what, folks? That wasn't good enough for investors. Investors wanted more. And that's the problem. It's like giving opioids and drugs. The investors, I should say, they remember the Fed Powell Put. Investors expected the Fed to get their back. But so what happened is that became like a drug, like opioids. And so basically, when you take drugs, you need more and more and more. And so when Jerome Powell didn't say the word pivot, he said he would raise rates and alluded that he would hold them and reassess. That was not good enough. So where's the market go from here? I'm not sure where equities are going to go because I think we're reaching part 2 where the P/E ratio may not go down further, but we're going to see a reduction in earnings estimates. So when you're looking at the P/E ratio from there, you're going to have a lower stock market because earnings, the denominator of that P/E ratio, is going to go down. The second thing I want to talk to you about, something I alluded in my last video, but people may not understand it because it's my fault I did not explain it. It's elasticity. I always like to look at elasticities. It's like looking at a correlation, but it's elasticity of correlations. You're saying, what the heck am I talking about? I'm talking about this. When I say elasticity, I'm talking about elasticity specifically of interest rates. How do interest rates react to economic news? Number one. Number two, how do interest rates react on the curve? Meaning, how are long-term rates reacting on news? Whether it's a Fed rate comment, whether it's actual economic news, how are long-term rates reacting? Meaning a 30-year rate and a 10-year rate. How are they reacting to news versus short-term rates? Because what you want to see is, number one, you want to see an inversion of the yield curve. And number two, you want to see long-term rates moving up less than short-term rates. Or you want to see long-term rates declining as short-term rates are increasing. That's going to be the key factor to see where long rates are going to go and where and when the Fed is going to actually pivot. And this is probably going to occur soon. My guess in the next few months. So stay tuned and come back to Lamb's Crypto.